Hello everyone. Again we get into another interesting topic which I had already promised you earlier that I will be doing, that is the bonds. So we will decode everything about bonds. Hope you find this interesting. So a bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or government or municipal. From seller's perspective, selling bonds is a way of borrowing money, and from a buyer's perspective, buying bonds is an investment as it guarantees principal repayment with continued interest payments. So, for a bond, there is a bond issuer and a consumer. Bonds can be in mutual funds or can be in private investing as well, where a person, otherwise called a lender, would give a loan to a company or the government. Typically, a bond is a agreement between a lender and a borrower with details of loans and payments. Bonds are normally used to fund or finance projects or operations or funding business expansion needs. Bond details include the maturity date, that is, the principal of the loan is due to be paid to the bond owner, otherwise called the bond receiver, and includes the interest payment details. This interest is otherwise called coupon rates. Interest can be fixed or else variable based on the bond type. The interest rate paid by the bond issuer to the bond owner is called coupon rate, as I mentioned above. Bond prices goes up when interest rates goes down and vice versa. So again, you must have heard RBI increased the repo rate by zero point 0.4. So as they have increased the repo rate by zero point 0.4, so interest rates have gone up by 0.4% or 40 basis point, means the bond yield can go up or the bond interest can go up. The rate of change of bond sensitivity to interest rates is called convexity. So now why bonds are issued, as you would be wondering. Governments and corporations regularly uses bonds to borrow money in huge sums. Government would need funds for infrastructure developments, nation building, or even for emergency war funding. There can be a number of reasons for government needing money. So that is a larger topic. Corporations will require funds raised from bonds to fund their capex needs, like to buy plant and property and equipment, R&D, or to expand their R&D facility, to fund project operations, etc., etc. So then now you know that why can't the borrower go to the bank rather than raising bonds? It's because large corporations and governments needs huge lot of sum for funding their large projects or needs. So normally banks can't raise such funds, and even banks would look into credibility of the borrower, and often they don't fit to the stringent criteria. So bonds really help in such cases. There are various ratings for the bonds. You must have already heard about it. Based on the quality and credit worthiness of a bond, it's rated. Example, triple A, triple B, double A, double B, etc. So higher the bond rating, lower the coupon rate and the interest rate it carry. Riskier bonds will have higher returns but can default and cause huge losses, like the IL and FS case in India. So bonds are tradable as well, meaning the initial bond holder can sell the bonds to other investors and don't have to hold till maturity. It's common for bonds to be repurchased by borrower if the interest rates decline or if the credit of the borrower has improved, and it can receive new bonds at a lower cost. Another term in bonds is face value. Face value is the amount the bond will worth at maturity. Coupon rates, already as you know, is the rate at which the interest payments are done. Another word is issue price. Issue price is the price at which the bond issuer originally sells the bond. If the issue has poor credit rating, the risk of the default is greater, as I mentioned above, and then bond pay more interest. Bonds that have very long maturity period also usually pays higher coupon rates. The higher coupon rate is due to bondholders' exposure to interest rate and inflation risks for this prolonged period. Credit ratings for a company and its bonds are derived or ratings by credit rating agencies like CRISIL, S&P, Moody's, etc. The highest quality bonds are called investment grade and include debt issued by government and very stable companies which are cash and asset rich. Bonds that are not considered investment grade but are not in default are called high yield or junk bonds. These bonds have higher risk of default in future and investors demand a higher coupon rate to compensate them for that risk. A zero coupon bond do not pay coupon payments, instead are issued at a discount to the par value that will generate a return once the bond holder is paid the full face value when the bond matures. Now, a convertible bond. So, convertible bonds are different instruments with an option that allows bondholders to convert their debt into stock at some point, depending mainly on the share price. Yield to maturity, YTM, is the internal rate of return of an investment in a bond if the investor holds the bond till maturity and if all the payments are made as per schedule. So you can see on the screen the equation for finding out the YTM. Many mutual funds combine various bonds under a simple umbrella and forms something called bond funds. So in the market there are various bond funds like short term funds, gilt funds, dynamic bond fund, etc. based on the characteristics or the type of the bonds in which they are invested in. Even there are gold bonds. So from all this you must be knowing that bonds are normally less riskier than stocks or equity and hence can always be considered in our portfolio for risk balancing. So there are even mutual funds wherein they call it as a hybrid fund. So hybrid fund is nothing but they have larger exposure to equity and they have even some amount of exposure to bonds as well. And even there are dynamic bond funds wherein they keep on changing the proportion of equity and debt funds. So debt funds are nothing but bond based funds. So bonds obviously are less riskier. So if the stock markets are having high fluctuations, they switch to more of bonds which are less riskier compared to equity, and once equity performs again they switch back to equity. So that is why the name dynamic. So instead of directly investing in bonds, I would say you opt bond funds through mutual funds so that you have a perfect diversification of your funds within a single fund or a multiple number of funds. So you can even park your liquid funds in bonds instead of in FD wherein you get very lower returns. So nowadays bond funds yield fairly good returns as well. So your liquidity can be maintained through bond funds, and whenever you have an opportunity to invest in equity, stock market, if you find a undervalued stock, so this cash can be held as bond funds and you can liquidate the bond funds and invest in equity. Again, bond funds just like mutual funds has got exit loads, so you also need to look into that as well. Happy investing.